want to beat a dead horse because I've said this in other videos, but when interest rates end up in the lower sixes and the fives, there's about 3 to 5 million additional qualified buyers that are going to enter into this housing market. And I believe that housing prices are going to skyrocket, just like we saw in 2020 and 2021. Based on my own personal experience, for me, the best times to invest in anything, it doesn't matter if it's real estate or not, is when you have the least amount of competition. And I know that, it goes against the grain to do the thing that people are not wanting to do, especially when the headlines are so catastrophic. But I want to give you 3 examples in my personal life in when I bought a primary residence when everyone thought I was insane. So the first time I bought when everyone else was like, absolutely do not buy, was in 2011. There were a bunch of news articles that said that 2011 would be the start of the second housing crash. I worked in mortgage at the time. We did not see any data that supported that. And there was a lot of government intervention, regarding buying interest rates down. And there was a lot of, I felt like, support in terms of tax incentives and things that they were willing to do to prevent that from happening. And so I took this as my opportunity to buy because, one, I had a long-term strategy. I planned on being in the property 5 to 10 years. I was going to get roommates, which I did, to help offset the mortgage payment. And I had assets myself to be able to make payments in case, God forbid, something happened. And so I took advantage of a bank foreclosure at the time. I used an FHA loan. And again, I got a pretty low interest rate and I got the seller to pay for my closing costs. So I felt good in all aspects. I paid the lowest amount of price because there was least amount of competition, and I got a really, really good deal. That property ended up making me about $88,000, which was awesome. It's actually how I started the Lizy Hoeffer team. I'm really proud of that first investment. The second time I bought was in 2018. And in 2018, there were big fears of a recession. Interest rates went into the 5s for the first time in a long time. And there was a real pullback on home appreciation. And I had wanted to live in this area called Arcadia. I loved it there. And it was a pretty hard neighborhood to buy in because there aren't a lot of listings for sale. And there is a lot of competition for those properties. And so I thought, okay, great. This is my chance. I'm going to buy this property. This is going to be my forever home. And I'm going to live here. And it doesn't matter what home prices do if they retract a little bit, because this is a long-term strategy. I bought that property at the time on an ARM so I could pay the least amount of interest. I mean, obviously we saw what happened like 4 years later. That property ended up doing extremely well. But at the time I was able to negotiate over $100,000 off on the price. I got the seller to pay for my closing costs. And I got into the neighborhood I've always wanted to be in with the least amount of competition. Me and my ex-husband did really, really well on that investment. And the last time that I bought was last August after my divorce. I still invested in real estate despite the high interest rates. Again, in this time I bought with an ARM so I could pay lower interest because I believe interest rates are coming down. I bought because I truly believe that there is going to be, especially if you make a long-term investment, that this property again will appreciate at a pace that I will be happy with. I think what's important here is that you understand when to take advantage of low competition, right? Because housing gives us utility, a place to live, and we've seen that it appreciates at minimum like 3 to 5%. It's gonna do better for you than just having the money in the bank. Albeit, yes, some rent is like way, way cheaper, but then you'd have to figure out where you'd be investing the money and not just spending it. So anyway, I digress. I feel like I've made really, really great in real estate investment purchases for the long haul with a plan that have turned out really great, despite what the media is saying. The reason I'm giving you all of these personal examples is because I think it's important to listen to people that practice what they preach and also have experience with the opposite. So you guys know, if you followed this channel, I also bought a property, my first one, when I was 23 years old on a 2-1 ARM that was interest only with my brother as my flaky roommate. And it was a horrible investment. I was house poor. I didn't understand ARMs. I didn't understand that home values could actually go down because we'd never seen it in the time that I'd worked in mortgage. And I was very underprepared for that purchase. I did end up selling that property at a loss because I didn't own it long enough. And it is one of the regrets I have in investing. But, I learned a lot about it. And there are some things I want to impart when it comes to affordability, what you should do if you find yourself in a similar predicament. My first mistake was that I did not buy when my budget was ready. So I bought a property assuming that my brother was going to subsidize the mortgage payment for me, and I didn't comfortably afford that payment even though I qualified for it. My first mistake was not understanding my budget. I know that there's a lot of house hackers out there that really promote getting a cosigner to qualify for you so that way you can rent out all the rooms and you don't have to make a mortgage payment. And while that is a strategy to purchase and it's one that has made people a ton of money, my belief is that if you cannot safely afford that property on your own, you should question whether or not you buy it. And if you do buy it, do you have sufficient enough assets in the bank to cover at least 6 months worth of payments and or maintenance? And for me, that's what makes that a way more secure investment, because the market is going to ebb and flow. You might lose your job, you might have a crisis, and you never want to be house poor or in a position where a leaky pipe is going to prevent you from getting your car fixed or prevent you from paying the mortgage. Okay, so my first mistake was not buying when my budget says it was ready. The second mistake I did was I didn't research enough loan products. There were much better loan products available at the time. When I met with my loan officer, I had about a 640 credit score, and they said subprime financing was the best for me, especially because I had received some of my bonuses as cash and I could use a bank statement loan to help me qualify. Now, this type of loan was only fixed for 2 years. It was interest only, but then it would adjust. And I didn't really fully understand the commitment I was making and the risk. One, because my loan officer didn't explain it to me, and they probably didn't because I worked in mortgage and just assumed that I knew. But I was 23 years old. So mind you, my brain wasn't fully formed. I just didn't understand and didn't research enough products. And I will tell you that lots of clients make this mistake. People will come to me and they will say, I want a 30-year fixed conventional mortgage. And I'll say, well, why do you want that? And they're like, oh, well, that's because that's what my parents said. And so it's super important that you work with people that provide you at least 3 options so that you know what to compare and you know what's available to you. That's a philosophy with my team, and it's really important as a consumer that you know what's available to you. At the time, I should have bought with FHA financing. Yes, I would have had to put down a down payment. My bank statement loan was 100%, but I would have had a cheaper interest rate and a lower monthly payment and something that was fixed and wasn't going to adjust on me when the market turned. So I wish I would have learned better mortgage products. And then the last thing that I really regret with that home purchase, just in general, I bought in a panic mindset. So I wasn't buying for long-term strategy. I was buying because I thought I might never be able to afford a property and that this was going to be the cheapest I would ever be able to buy something. And I think when you make a panicked financial decision, it's not based on strategy or logic or what you want to see in terms of returns. I just was a bad overall money choice. Anytime I've ever made a money decision based on fear, it's never worked out for me. I really regret that. And so do not buy a property if you're only buying it because you're worried you won't afford it. Things I did well. At the time, what would have also made more sense, and this is like maybe a mistake and a win, is that I chose to buy it with a family member. So buying it with my brother was actually the reason that I got off the fence. Now, he should have been on the mortgage with me, otherwise he wouldn't have bailed so easily. Buying with a family member, I don't think is a bad thing at all. I think you just have to understand that you're buying and investing together and really identify who's paying what percentage you expect back, what happens if you have a disagreement, like really have a good contingency plan. There's lots of people that do real estate contracts, right, that are separate from the purchase. There's a lot of different people that I could recommend for that if that's something that you guys wanted to do. But there's lots of different cohabitation and co-ownership agreements that people put in place when they're investing together. And I think it's a really awesome strategy to implement, especially if you're a first-time homebuyer. So that's one way that you can afford a property if you find yourself to be strapped. And that was one thing I thought I did well, albeit I didn't choose the most responsible person to do that with, even though I love him very dearly. The other thing that I thought I did well is I actually bought a townhome. So I bought a property that connected to other units. It wasn't a condo. So what I like about townhomes versus condo is you actually own the land underneath you and there's no one on top of you. So they're easier to resell and they're actually easier to finance. So I bought a townhome. Because the properties are connected together and you share the community amenities, you pay a lower price, even if you're paying a homeowners association. My homeowners association included water and sewer and garbage. and it also did landscaping, and I could use the pool and the gym. So it also helped me offset some other expenses I would have had. So I thought I did that really well. And I also bought in an up and coming area that I thought was going to appreciate. And had I kept that property, it really did turn out to have appreciated very well. So those were the things I thought I did well. Now I want to jump topics slightly and really talk about if you find yourself in a position where you cannot afford a property but you want one, what are things that you can do? Well, like I said before, I think partnering with a family member or friend that you are willing to invest together with, I think is a great strategy, especially for your first home. I know lots of people do this, and it was actually a really popular strategy back when interest rates were high like this in like the 80s. There is something called joint tenants in common, which is where you buy a property with somebody who's not your spouse, and you buy and you invest. And like I recommend getting that cohabitation agreement that talks about the investment, what percentage of return you expect, what happens if you guys get in a fight, what happens if one person wants to sell or move out. It's just gonna handle all of the contingencies, right? The things that might go wrong, and you just wanna handle that up front. But I know lots of people who do this together. Two of my favorite clients have bought 6 different properties together. They're just best friends, and they've turned them into rental properties, and it's been an amazing investment strategy for them. One thing that they did too that I love is that they could safely both pay for the payments, but they house hacked at the same time. So each one of the properties that they live in, they also rent out the rooms for, and it really helps them offset the mortgage payment. And then as they vacate these properties, they turn the other property that they just left into a long-term rental or an Airbnb. That's really great ways of maximizing your primary residence and utilizing a friend for a long-term portfolio or investment strategy. Let's say you don't want to buy with a friend. What does it look like to buy with a family member? Well, a lot of parents help their children invest in primary residences. I will say that if they're helping you co-sign, that I would probably do something similar to what you would do with a friend, and I would understand and outline the terms of the investment. So part of the reason that I don't love co-signing is because the co-signer typically feels like they have no responsibility for making the payment, but you are agreeing to co-sign for somebody that cannot qualify for the loan. Now, there's a variety of reasons for why that is. Sometimes people can't document all of their income, or one person can't be on the loan, and all of it, but you should really have defined terms of what their responsibility is to the purchase and what returns they expect to have in back. The reason I mention this is because a lot of times parents will buy for their kids with the expectation that they're going to do this house hacking practice, and then let's say one of their roommates flakes out, but the kid does not qualify for the mortgage payment themselves. That parent should be aware that they're going to help make that mortgage payment, and it should just be outlined up front. The other way that I've seen people finance with their family is they do generational housing. So they either buy a property that can fit their parents and themselves, or they're buying for like an elderly family member that will be living with them and having that person help offset their mortgage payment. It's a really great strategy. In fact, Phoenix just made it easier for you to build a casita in the back of your home for this primary reason. And, you know, I think since the Great Recession, I don't feel like it's uncommon to be living at home with your parents in older ages. And so I think that this is another really great strategy, even buying with a sibling, right? 2 siblings buying together, 2 families buying together. It might make sense, especially as home prices increase. For those of you who do not know, this is just like some more personal details. I'm from Nogales, Arizona. My family is Mexican, and it's really not uncommon, especially in immigrant culture, for multiple family members to purchase together, for multiple generations of families to live together and purchase together. It's a lot of how immigrant families invest in real estate and they make money in real estate. And so I'm a huge proponent of buying a property this way. Now, I know that there's some people who are gonna say, gosh, I don't have any family members, I don't have any friends that I would invest in real estate with. And I've recorded some videos on how to structure your loan for better monthly payments and what to do with budget. So I don't really want to go into that, but I will link those videos. You could also just relocate areas. And I know that that sounds kind of bananas, but one of the things that I did is I actually ended up moving 45 minutes away to an area that was lower priced, because that's what was most affordable. So like in Phoenix, you might want to consider like a Casa Grande or areas around Casa Grande. Those outskirted areas are typically more affordable because they're less developed. And again, real estate is a long-term strategy. And in most cities, I mean, throughout the country, People are accustomed to 45 to 1.5 hour commutes. It does come at a time sacrifice, but it is another way of making things more affordable for you. Now, let's say none of those areas are affordable. Could you do the same job in a different area? So like there's different states that are more affordable than Arizona. And I know people are very attached to location, and but we are working in a climate where people are able to work remotely. And we are in a climate where there's still relatively very minimal unemployment, so you can find a job. And so I think that if investing sooner rather than later is important to you, and we all know that the long-term trajectory is yes on that if we're looking for maximizing returns, then looking into a cheaper location makes sense. I mean, I've had a lot of investors who are like, okay, I can't invest in Arizona anymore, but I'm looking in, other parts of the country and, places that will cash flow or I can buy in cash that are still very affordable areas. And you might not make as large of a return as you want, but over time, this stuff compounds and it's a good thing to consider. Like with all things, not everything will work for your lifestyle. And yes, every type of investment comes with a sacrifice, either monetarily, time-wise, location-wise, lifestyle-wise. I mean, they all come with some kind of penalty. I hope that this gave you some ideas for how to invest in a property if you are struggling with affordability. I hope it gave you some ideas and some clarity around how to really define that investment so that you're making the right choice for you, and that you're planning for, just in case, worst case scenario. So let me know what questions you guys have. And if you found this video to be helpful, guys, don't forget to like, comment, and subscribe and share it with a friend.